It's Saturday morning, January 24th, 2026. Silver is showing $103.07 on your screen. You're probably feeling pretty good about that if you've been stacking. But here's what's actually happening right now while you're reading this. Call your local coin shop. Try to sell them a tube of Eagles. See what they say. I'll save you the phone call. They're going to tell you they're not buying. Not at a discount. Not at spot. Not at all. No bid. That's the phrase you're going to hear from dealers across the country today, and it's the most important two words in precious metals right now. Now, the financial media, the people who spent the last 3 years telling you silver was a Reddit meme, are starting to notice the price. They're running headlines about retail frenzy and speculative excess and warning about a bubble. They want you to think this is some kind of panic buying from amateurs who don't understand markets. They want you to believe the fundamentals haven't changed. They want you to sell. But here's the problem with their narrative. If this was just retail hysteria, your local dealer would be thrashing to buy from you. They'd be offering 70, 80, 90% of spot, desperate to restock their shelves to flip to the next guy walking through the door. That's how retail panics work. Dealers make a fortune in the churn. Instead, they're sitting there with their hands in their pockets telling you they can't take your metal at any price. So let me ask you this. What kind of bubble makes the middlemen go broke on the way up? I've been analyzing physical commodities for 12 years, and I've never seen anything like what's unfolding right now. The AI you're watching is just how I get this intel out fast. If you want the full backstory on the human behind the channel, check the intro video. But right now, I need you to understand something critical. Your screen says silver is up 7% today. Your dealer says your silver is worth 0 to them. Those two things cannot both be true in a functioning market. What you're witnessing is the wholesale plumbing of the global silver market bursting in real time. And if you think the no-bid situation is bad on a Saturday when the markets are closed, wait until the COMEX opens Monday morning. That's when this gets nuclear. Let me be very clear about what this video is and isn't. This isn't a price prediction. I'm not going to tell you silver is going to $200 or $500 or whatever number gets clicks. This is a structural breakdown analysis. The silver market isn't just hot. It's not just in a bull run. It's broken at the foundational level. The very institutions that are supposed to provide liquidity, the wholesalers, the major dealers, the guys who keep the machine running, are being liquidated by the price rally itself. And I'm going to show you exactly how that's happening. Here's what I'm going to walk you through in the next few minutes. First, the mechanism. I'm going to peel back the curtain on something called the delta neutral hedging trap. This is the technical reason why dealers like SD Bullion are suddenly no bid, even though silver is at all-time highs. It sounds complicated, but I'm going to make it so simple you could explain it to your neighbor. Second, the math. We're going to run the actual stress test numbers on what's happening at the COMEX. The registered inventory has drained 26% in 21 days. I'm going to show you what that means for the March delivery month and why the numbers simply don't add up to a functioning market. Third, my personal battle plan. I'm going to tell you exactly what I'm watching for on Monday morning and what my if-then triggers are. I'm not going to tell you what to do. I'm going to tell you what I'm doing and why. The stakes here aren't just about hitting some arbitrary price target. What we're watching is the permanent decoupling of physical metal from the digital illusion. For decades, the paper price has dictated what physical trades for. That's been the reality. Futures contracts on the COMEX set the global spot price, and physical metal traded at a small premium or discount to that number. That system is dying. When dealers go no bid, it means the paper price has become irrelevant to the physical market. It means the pricing mechanism itself has failed. And once that breaks, it doesn't just snap back. This isn't a temporary dislocation that gets arbitraged away. This is a phase change in how silver gets valued and traded. So if you're still thinking about this in terms of when do I sell to take profits, you're missing the bigger picture. The screen is lying to you, and I'm going to show you how to see through it. All right, let's establish the baseline reality. I was looking at the markets a few hours ago this morning, around 10:30 Eastern Time. Silver spot, $103.07, new all-time high. Gold, $4,982.49. The gold to silver ratio, 48 to 1. Just to put that in perspective, 6 months ago that ratio was sitting at 90 to 1. Silver has been absolutely screaming relative to gold, and that's not normal market behavior. That's not a smooth bull market. That's a supply crisis showing up in the price. Now, here's where it gets interesting. On January 1st, China implemented formal export restrictions on refined silver. This isn't a rumor. This isn't some blog post. This is state policy from the world's largest silver refiner. China has effectively cut off the West from the primary source of newly refined physical metal. They're keeping it domestic for their own industrial needs. Solar, EVs, semiconductors, all the strategic industries they're trying to dominate. If you want the deep dive on why that's permanent and not some temporary trade negotiation, go watch my previous video on the China export ban. I spent 20 minutes walking through the geopolitical calculus. It's not coming back. So that's the supply side. The spigot is off. Now let me tell you what's happening on the dealer side, because this is where it gets truly strange. Tyler Wall, the CEO of SD Bullion, one of the largest online precious metals dealers in the country, went on record this week describing the wholesale market as a circus. His exact words. A circus. Major refiners are no bid on junk silver. That means bags of pre-1965 dimes and quarters, the stuff that's usually the most liquid form of physical silver you can trade, are effectively untradeable at the wholesale level. Dealers aren't buying it. Refiners aren't processing it. It's just sitting there. Now you might think, okay, that's weird, but maybe it's just a temporary backlog. Maybe the refiners are swamped with orders and they're just being selective about what they take in. Except here's the problem. The COMEX registered silver inventory, the physical metal that's actually available for delivery against futures contracts, has fallen 26% this month. 26% in 21 days. That's not normal volatility. That's not some seasonal pattern. That is a bank run. Somebody is taking delivery of enormous quantities of physical metal and pulling it out of the exchange system. So let's just recap the snapshot for a second. The paper price says $103. The physical dealers are no bid. The refiners won't touch junk silver. The COMEX vaults are hemorrhaging inventory. And China has closed the export doors. Every single piece of this puzzle is pointing in the same direction. The physical metal is disappearing, and the digital price is becoming meaningless. But the inventory drain is just the symptom. The disease, the actual mechanical reason why this is happening, is something much more technical and much more terminal. Okay, this is the section where I need you to slow down and actually think through the mechanism with me. This is the part that most people miss because it's technical and it's boring and it sounds like inside baseball. But this is the kill shot. This is why the dealers are broke. This is why no bid is the new reality. So let's pull this apart. When a precious metals dealer buys physical silver for their vault, they don't just sit there and hope the price goes up. They're not speculators. They're middlemen. Their job is to facilitate transactions and make money on the spread, not to take directional bets on the metal. So here's what they do. They hedge. Let's say a dealer buys 1,000 ounces of physical silver at $30 an ounce. They just spent $30,000, and they've got 1,000 ounces sitting in their vault. If the price of silver drops to $25, they just lost $5,000. That's not a business model. That's Russian roulette. So to protect themselves, they go to the COMEX and they short 1,000 ounces of silver futures at $30. Now they're what's called delta neutral. If silver goes up, the physical in their vault gains value, but their short position loses value. If silver goes down, the physical loses value, but their short gains value. It all nets out. They're hedged. This is standard practice. This is how the entire wholesale bullion market operates. Every major dealer does this. Now, here's the trap. Silver didn't go from 30 to 35. It went from 30 to 100. So let's do the math on what just happened to that dealer. The physical silver in their vault is now worth $100,000. They're up $70,000 on the metal itself. But their short position on the COMEX, the futures contract where they sold 1,000 ounces at $30, is now losing $70,000. It nets out, right? They're still delta neutral. No problem. Except there is a problem. A massive problem. The short position isn't just a theoretical loss, it's a margin call. When you short a futures contract and the price moves against you, you have to post margin, real cash, immediately to keep that position open. The exchange doesn't care that you've got physical silver in a vault somewhere. They want cash in your account right now, or they're going to liquidate your position. So this dealer has $70,000 of unrealized profits sitting in their vault in the form of physical silver, and they have a $70,000 margin call they have to meet immediately in cash. They are asset rich and cash dead. Think of it like this. Imagine you're a used car salesman. You've got 10 Porsches sitting on your lot, and they're all paid for. You're a millionaire on paper, but your bank account has $50 in it because you took out a massive short position betting against Porsche stock, and the stock just went up. And now your broker is calling you, demanding $100,000 in cash by the end of the day, or they're closing your position and you're bankrupt. You've got $1 million in cars, but you can't buy a sandwich. That's the liquidity trap. That's why dealers are no bid. They literally do not have the cash to buy your silver, even though silver is at all-time highs, because every dollar they have is being sucked into margin calls on their short positions. And here's the kicker. The higher silver goes, the worse it gets. This isn't a problem that resolves itself when the price stabilizes. This is a death spiral. If silver goes from 100 to 110, they need to post another $10,000 per 1,000 ounces. If it goes to 120, another 10,000. They can't liquidate the physical to raise cash because if they do, they're no longer hedged. And then they're just naked short in a ripping bull market, which is a guaranteed wipeout. So they're stuck. And that's why the phrase no bid is spreading through the dealer network like a contagion. It's not because they don't want your silver. It's because they are mathematically unable to buy it without triggering their own insolvency. Now stop. Look at the COMEX inventory chart from the last 21 days. You see that, Cliff? That's not normal liquidation. That's not profit taking. That is the physical manifestation of dealers being forced to deliver into contracts because they can't maintain their hedges anymore. The margin calls are breaking them, and the only way out is to deliver the physical and close the short. But when everyone is trying to do that at the same time, you get a bank run on the COMEX vaults. And that's exactly what we're seeing. All right, let's move from the mechanism to the actual stress test. I want to show you why the numbers don't add up and why Monday morning might be the day the music stops. Here's the conservative baseline scenario. Global industrial demand for silver, solar panels, EVs, AI data centers, semiconductors, is running at roughly 1.2 billion ounces per year. That's not speculative. That's based on publicly reported industrial consumption data from the Silver Institute and the major industry players. Mine supply is roughly 820 million ounces per year. Recycling adds another 180 million ounces, though there's reason to believe that number is about to crater, and I'll get to that in a second. So in a normal year, you've got about 1 billion ounces of total supply against 1.2 billion ounces of demand. That's a 200 million ounce deficit. That deficit gets filled by above ground stockpiles, government reserves, ETFs, private hoards, dealer inventories, all the metal that's been sitting around for decades. But here's the problem. Those stockpiles aren't infinite and they're draining fast. Now let's layer in the China export restriction that went live on January 1st. China refines about 30% of the world's silver. They're not exporting it anymore. That means the effective global supply available to the West just dropped by roughly 250 million ounces per year. So now you're looking at a total supply of 750 million ounces against demand of 1.2 billion ounces. That's a 450 million ounce deficit per year. There is no stockpile on Earth large enough to fill that gap for more than a few months. Now let's talk about the COMEX specifically, because this is where the math gets truly insane. As of this morning, there are open delivery notices for over 10,000 March contracts. Each contract represents 5,000 ounces. That's 50 million ounces of silver that is supposed to be delivered in the next 6 weeks. The COMEX registered vault, the metal that is actually available for delivery, currently holds approximately 70 million ounces after the 26% drawdown this month. So on paper, there's enough metal to cover the deliveries. Barely. But here's the thing, that 70 million ounces isn't just sitting there waiting to be delivered. A huge chunk of it is already spoken for. It's pledged as collateral. It's part of existing hedges. It's already allocated to other contracts. And more importantly, the trend is accelerating. If another 10,000 contracts stand for delivery in April and another 10,000 in May, you're looking at 150 million ounces of demand against a vault that's shrinking every single day. The gap is widening, not closing. Now, there's an unverified rumor circulating in the wholesale market that several major industrial users, solar manufacturers, EV battery makers, are liquidating their unallocated silver accounts and demanding physical delivery. I can't confirm that. I don't have firsthand knowledge, but if it's true, it would explain the violence of the drawdown. Unallocated accounts are basically IOUs. The industrial user has a claim on silver, but it's not physically segregated in a vault somewhere with their name on it. It's part of a pool. If those users are now saying, no, we want the actual metal, we want it segregated, we want it in our custody, that creates a run on the pool. And if the pool doesn't have enough metal to satisfy all the claims simultaneously, which it almost certainly doesn't, then you get a force majeure event. That's a fancy legal term for, sorry, we can't deliver the metal, here's cash instead. Except in a market where silver is $100 and climbing, nobody wants cash. They want the metal. So here's the checkpoint recap. We are in a 450 million ounce annual deficit due to industrial demand and the China export ban. The COMEX is seeing unprecedented delivery demand, 50 million ounces standing for March delivery alone. The registered vault inventory has cratered 26% in 3 weeks and is down to roughly 70 million ounces, most of which is already encumbered. The math does not work. The numbers do not add up to a functioning market. We are looking at a potential force majeure event where the exchange simply cannot deliver the physical metal and is forced to settle in cash. And when that happens, the entire pricing mechanism breaks. Because if the COMEX can't deliver, then the COMEX price is no longer the spot price. It's just a number on a screen that has no connection to physical reality. Now, if the math is this terminal, why isn't everyone panicking? Why are the mainstream financial outlets still talking about this like it's a normal bull market? Because of the skeptics. And I need to address their arguments head on, because they're not stupid and they're not wrong about everything. All right, I want to be fair to the counter-arguments here because there are smart people who think this is overblown. Let me give you the strongest version of the skeptical case, and then I'll tell you why I think it's wrong. Skeptic argument. Number one, the scrap wave is coming. The argument goes like this. Silver is at $100. That's 4 times higher than it was a year ago. At these prices, every grandmother in America is going to dig through her attic and sell her old silverware. Every pawn shop is going to be flooded with sterling. The scrap supply is going to come pouring into the market and overwhelm the deficit. High prices cure high prices. Supply responds to demand. This is basic economics. And on the surface, that's a reasonable argument. Historically, big price spikes in silver have triggered massive scrap flows. In 1980, when the Hunt brothers pushed silver to $50, the scrap market went absolutely berserk. People were melting down family heirlooms. The supply response killed the rally. So why wouldn't that happen again? Here's the problem. The refiners can't process the scrap. There's a rumor, and again, I can't fully confirm this, but it's coming from multiple sources in the industry, that there's a nitric acid shortage. Nitric acid is the key chemical used to refine scrap silver. You need it to dissolve the base metals and separate out the pure silver. If the refiners can't get nitric acid, they can't process scrap, no matter how much of it shows up at their door. And why would there be a nitric acid shortage? Because nitric acid is a critical input for fertilizer production, and fertilizer demand has been through the roof due to food security concerns and geopolitical instability. The chemical supply chain is being pulled in 10 different directions, and silver refining is not the top priority. So even if the scrap wave materializes, if the refiners can't turn it into deliverable bars, the new supply never actually hits the market. It just sits in a warehouse somewhere, waiting for processing capacity that may not come for months. That's rebuttal number one. Now, skeptic argument number two, industrial users will just substitute. The argument here is that at $100 an ounce, industrial manufacturers are going to find alternatives. Solar panel makers will redesign their cells to use less silver or switch to copper. EV manufacturers will find a different material for battery contacts. Demand destruction is real. Nobody's going to pay $100 an ounce for a commodity if there's a cheaper alternative. And again, this sounds reasonable. But it's wrong for a very specific technical reason. Silver is the most conductive element on the periodic table. You cannot run a high-efficiency photovoltaic cell without silver. Copper is more resistive. You lose conversion efficiency. The panel generates less power. The economics don't work. You cannot run an AI data center or a next-gen semiconductor fab on copper wiring. The resistance creates heat. The heat creates failure. The performance loss is unacceptable. Silver isn't just a commodity, it's a physical property. It's the best electrical conductor we have, and there is no substitute that performs at the same level. So yes, at the margin, some low-end applications might switch to cheaper materials, but the high-end mission-critical applications, the AI boom, the energy transition, the electrification of everything, those applications cannot substitute. They need silver, and they need a lot of it. And that demand is not price elastic. They'll pay whatever it takes. That's rebuttal number two. Now, let me hit the big myth directly. High prices solve high prices. This is the argument you hear from traditional commodities analysts who cut their teeth on oil and copper and wheat. And in normal markets, it's true. High prices incentivize new production. High prices trigger substitution. High prices ration demand. The market rebalances. But we're not in a normal market. We're in a credit crisis disguised as a commodity rally. Here's what I mean by that. In a normal bull market, dealers make a fortune. They buy low, sell high, capture the spread, rinse and repeat. But in this market, high prices are causing the insolvency of the dealers. The delta neutral hedging trap I explained earlier means that the higher silver goes, the more cash the dealers need to post as margin, which means they have less cash to buy inventory, which means liquidity dries up, which means the physical market seizes. High prices are making the problem worse, not better. This is the opposite of a normal supply-demand rebalancing. This is a structural failure of the market mechanism itself. And once the dealers go no bid, the pricing mechanism is broken. The paper price becomes irrelevant. At that point, it doesn't matter if silver is at 100 or 200 or 500 on the screen. If you can't buy it and you can't sell it, the number is meaningless. All right, let's talk about what happens when the COMEX opens Monday morning. I don't have a crystal ball. I can't predict the future. But I can tell you what the institutional playbook looks like in a situation like this, and I can tell you what I'm watching for. First, expect a margin hike from the CME group. This is standard procedure when volatility gets out of hand. The exchange will raise the amount of cash you need to hold a futures contract, and they'll do it to force weak hands out of the market and calm things down. I'm expecting a 50% margin increase at minimum, maybe more. That's going to trigger a wave of forced liquidations from over-leveraged speculators. You're going to see a lot of long positions get closed out simply because people can't meet the new margin requirements. In the short term, that could create a dip. Maybe silver pulls back to 90, 95, maybe lower. But here's the key. A margin hike doesn't solve the underlying problem. It doesn't create new supply. It doesn't fix the dealer liquidity crisis. It doesn't make the China export ban go away. All it does is temporarily reduce the number of open contracts and give the exchange a bit of breathing room. But if the fundamental deficit is real, the price is just going to resume climbing once the margin liquidations are over. Second, watch for rule changes. This is where things get really interesting. If the COMEX is facing a genuine force majeure situation, if they literally cannot deliver the physical metal to satisfy the open contracts, they have two options. Option one, default. Admit they can't deliver, blow up the exchange's credibility, trigger a cascade of lawsuits and regulatory investigations. Option two, change the rules. And I guarantee you they're going to pick option two. What does that look like? Cash settlement only for certain contract months. They'll announce that March delivery contracts can only be settled in cash, not physical metal. They'll come up with some justification about market integrity or preventing manipulation. And technically, it's within their rights. The exchange rules allow for cash settlement in extraordinary circumstances. But make no mistake, if they do that, it's an admission that the market is broken. Because the whole point of a futures contract is that you can take delivery of the physical commodity. If you can't do that, it's not a futures market. It's just a casino. And once the COMEX goes cash settlement only, the paper price officially decouples from the physical market. At that point, you're going to see two prices, the COMEX digital price and the street price for actual metal. And I expect the street price to trade at a significant premium. How big? I don't know. Maybe 20%? Maybe 50%? Maybe more. It depends on how desperate physical buyers are and how scarce the metal actually is. Now, here are the specific indicators I'm watching on my personal dashboard. Indicator number one, silver lease rates. If lease rates stay above 80%, it means the big bullion banks are hoarding metal and refusing to lend it out. That's a sign of an internal bank run. They're pulling metal out of circulation and holding it in reserve because they don't trust the system. As of this morning, lease rates were hovering around 75%. If they cross 80 and stay there, that's a red flag. Indicator number two, delivery notices for March contracts. Right now, we're at around 10,000 contracts standing for delivery. If that number crosses 12,000, it's game over for the COMEX vault math. There's simply not enough registered metal to satisfy the demand. At that point, I expect the CME to announce emergency rule changes within 48 hours. Now, there's one more thing I need to mention, and I'm going to be very careful about how I say this because I don't want to spread panic based on unverified information. There is a rumor circulating that one of the top 3 wholesalers in the United States is on the verge of defaulting. I cannot confirm this. I have not seen any official statement. This is secondhand information from people in the industry. But if it's true, if a major wholesaler actually goes under, the retail market goes completely dark. Every small dealer in the country relies on a handful of major wholesalers for their inventory. If one of those wholesalers collapses, the entire downstream supply chain seizes up. You won't be able to buy silver from your local coin shop. You won't be able to order online. The market will just freeze. And at that point, the only people who have silver are the people who already own it. So that's the scenario I'm watching for on Monday. Margin hikes, rule changes, delivery failures, potential wholesaler defaults. This is not a normal trading day. This is a stress test of the entire market structure. And I think there's a very real chance it fails. All right, let me tell you how I'm positioning for Monday. This is not advice. This is just me walking through my own triggers and decision points so you can see how I'm thinking about this. First, trigger A. If silver breaks $110 on Monday, I'm stopping all retail purchases. Here's why. At 110, the premium over spot at most dealers is going to be 30, maybe 40%. That means I'd be paying $145 an ounce for silver eagles that have a paper spot price of 110, and I refuse to do that. Not because I don't think silver is going higher, I do, but because I don't want to pay a massive premium to a dealer who is just trying to cover their margin calls. If I'm going to overpay for silver, I want it to be because I'm buying directly from another individual who actually owns the metal, not from a dealer who's using my cash to plug a hole in their balance sheet. So if we hit 110 and the premiums are out of control, I'm sitting on my hands until the market stabilizes or I find a better entry point. Second, trigger B. If lease rates stay above 80% for more than 3 consecutive days, I'm holding every ounce I own and I'm not selling anything at any price. Here's the logic. Lease rates above 80% mean the bullion banks are hoarding. They're not lending metal out, they're not providing liquidity, they're battening down the hatches. And if the bullion banks, the guys with the deepest pockets and the best information, are acting like there's a shortage, then there is a shortage. At that point, I don't care what the paper price says. I'm not parting with physical metal until I see lease rates come back down and the banks start acting like the market is functioning again. Now, here's my street strategy. If the no-bid situation persists at dealers, if I call around on Tuesday and Wednesday and I'm still hearing that they won't buy, then I'm going to start looking to buy directly from individuals at spot price. Here's how that works. Let's say I call a dealer and they say, we're not buying right now. Then I'm going to offer to buy from any of their customers who are trying to sell. I'll pay spot, no premium, just straight one-to-one based on the paper price. If the dealer won't take it, but I will, then I'm in a position to accumulate metal at a fair price while the institutional market is frozen. Now, is that risky? Absolutely. I'm buying physical metal in a market where the liquidity has collapsed. If I need to sell it next week, I might not be able to. But I'm not planning to sell it next week. I'm planning to hold it for years. And in a market where the dealers are no bid, being the guy who's willing to buy makes you the new market maker. That's a powerful position to be in. Now, here's my final trigger. If the CME hikes margins by more than 50%, I'm sitting on my hands for at least 72 hours. Here's why. A massive margin hike is a forced cooling off period. It's the exchange trying to shake out the speculators and reduce the number of open contracts. In the immediate aftermath, you usually get a sharp sell-off as over-leveraged traders get liquidated. But that sell-off is artificial. It's not based on fundamentals. It's based on forced selling. So I'm going to wait for the dust to settle. I'm going to watch the delivery notices. I'm going to watch the lease rates. And I'm going to see if the price stabilizes or if it resumes climbing once the margin liquidations are over. If it resumes climbing, that tells me the deficit is real and the margin hike didn't solve anything. And then I'll reassess my positioning. But I'm not going to panic buy into a margin hike-induced dip. I'm not going to try to catch a falling knife. I'm going to be patient, stay liquid, and wait for clarity. That's my personal battle plan. Your situation might be completely different. Your risk tolerance might be different. Your time horizon might be different. But that's how I'm thinking about this. All right, let's pull this all together. Here's where we are. Silver is at $103.07 as of this morning. The dealers are broke. The delta neutral hedging trap has them in a liquidity crisis, and they're no bid across the country. The COMEX registered vault has drained 26% in 3 weeks, and the math doesn't add up to a functioning delivery system. China has shut off exports, and the global supply deficit is somewhere between 300 and 450 million ounces per year, depending on how much industrial demand is hidden in unallocated accounts. The skeptics say the scrap wave is coming, but the refiners can't process it without nitric acid. The skeptics say industrial users will substitute, but silver is the most conductive element on the periodic table, and mission-critical applications can't switch to copper without massive performance losses. The skeptics say the high prices cure high prices, but in this market, high prices are causing the insolvency of the middlemen, which is making the liquidity crisis worse, not better. So here's my forecast for Monday. I think we are about to witness the most volatile trading day in precious metals in 50 years. I think the CME is going to hike margins. I think we're going to see forced liquidations. I think we might see emergency rule changes. And I think we are watching the great decoupling in real time. For decades, the paper price has been the real price. The COMEX futures market set the global spot price, and physical metal traded in reference to that number. That system is dying. When dealers go no bid, when lease rates spike, when the vaults drain, when the exchange can't deliver, the paper price becomes a fiction. It's just a number on a screen that represents a market that no longer exists. And at that point, the only price that matters is the price at which two people are willing to exchange physical metal. That's the street price. That's the real price. And I expect it to diverge massively from the COMEX price over the next few weeks. How far? I don't know. But I think we're going to see premiums that would have been unthinkable 6 months ago. Because here's the thing. They want you to think this is a digital game. They want you to think that the price on the screen is the price, and that markets are efficient, and that supply and demand always balance, and that the system works. But the system doesn't work when the plumbing breaks, and the plumbing is broken. This isn't about charts. This isn't about technical analysis. This isn't about predicting whether silver hits 120 or 150. This is about who holds the physical atoms when the music stops. And the music is about to stop. So here's my rallying cry, and this is the note I want to end on. If you own physical silver, you are not playing the same game as the people trading futures contracts on the COMEX. You're not exposed to counterparty risk. You're not exposed to margin calls. You're not exposed to rule changes or cash settlements or force majeure clauses. You own a tangible asset that has held value for 5,000 years. and you own it outright. That matters. In a world where the financial system is increasingly digital, increasingly abstract, increasingly built on leverage and derivatives and promises, holding something real is a form of insurance. And right now, that insurance policy is starting to pay off, not because the price went up, but because the system is revealing its fragility. When the dealers go no bid, they're telling you that the paper system can't handle the physical reality. When the COMEX drains its vaults, it's telling you that the promises outnumber the atoms. When China shuts off exports, it's telling you that the global supply chain is not as resilient as you thought. Pay attention to what the market is showing you. Not what the headlines say, not what the talking heads on CNBC say, not what the price on the screen says. Watch what the insiders are doing. Watch the lease rates. Watch the delivery notices. Watch the vault inventories. Those are the numbers that tell you the truth. And the truth right now is that the silver market is in structural failure. So if you want to understand why this is different from every other bull market you've seen, that's why. This isn't about speculation. This isn't about momentum. This isn't about retail investors piling in. This is about a supply deficit that cannot be solved by higher prices, because the middlemen who would normally arbitrage the gap are being liquidated by the rally itself. That's the paradox. That's the trap. And that's why Monday morning is going to be absolutely critical. All right, that's where I'm at. The situation is moving fast. If you want more context on the supply side collapse, go watch my previous video on the China export ban. I spent 20 minutes walking through why that's permanent and not some temporary trade spat. And stay frosty. Because the next 72 hours are going to define the next decade of the precious metals market. I'll see you on the other side.